Welcome to the Great Divorce Podcast, hosted by divorce financial analyst and retirement planning counselor Andrew Hatherley. Join Andrew and guest experts as they help late-life divorcees build the financial and mental foundation for a meaningful future. There is life after divorce. Now, on to the show.
Hello, everybody, and welcome to the Great Divorce Podcast. Are you married to your mortgage? What I mean is, are you thinking about divorce or in the process of divorce, but nervous about leaving or selling your primary residence if you've got a low interest rate on your current mortgage? I came across some statistics on Redfin recently showing that 86% of U.S. homeowners with mortgages have an interest rate below 6%, and a substantial 57.4% of homeowners have a mortgage below 4%. That can be hard to give up, but if you're getting divorced, you may have no option. I get it. Who wants to trade in a 4% mortgage for a new mortgage at 6 or 7%? Well, my guest today is Jennifer Brown. Jennifer is a 27-year veteran of the mortgage industry and a certified divorce lending professional. Jennifer focuses her practice on helping divorcing homeowners make a more informed decision regarding home financing solutions. And she works with divorce financial analysts like me and family law attorneys to help identify any potential conflicts between the language of the divorce settlement and the type of language mortgage lenders need to see to provide financing. Jennifer has originated mortgages in Metro Atlanta since 1998 and is licensed in Alabama, Florida, Georgia, South Carolina, and Tennessee. That's a good southeastern concentration there. In 2019, she became a partner and co-owner of Neighborhood Mortgage, Inc., founded in 2001. And one final thing, both Jennifer and I are on the leadership team of the Amicable Divorce Network. The Amicable Divorce Network is a group of divorce professionals dedicated to helping families navigate divorce through the amicable divorce process, a more civilized, cost-effective alternative to divorce litigation. Jennifer, welcome to the Great Divorce Podcast.
Hey, Andrew. Thanks for having me.
Great to have you on the show. I know we've been trying to get this for a while, and I'm glad that we finally were able to schedule it. So, Jennifer, this concept of being married to your low interest rate mortgage, tell me, what are you seeing out there right now with couples and divorcing couples, particularly with a reluctance to part with a home that may have a very low interest mortgage rate?
Well, I do a lot of amicable work, right? And so it really depends on the divorcing couple and their situation. Do they have school-age children where maybe they need to stay in a specific school district for a specified period of time? Can they afford to refinance because one person's moving out? Obviously, they're going to have housing expenses now. So everyone is different, right? If you want to keep your mortgage term, then you've got to keep that mortgage intact, right? So you have two options. Either you can try to assume the mortgage, or you can just stay obligated. Both parties can stay obligated on the mortgage, and that's going to be a very high trust situation, right? I mean, you typically are only going to see that in the most amicable of cases, and usually there is some specified end time that you're going to have to take action by X date. But what I am seeing in those situations is a much longer period of time defined in the settlement agreement on how long they have to either refinance, assume, or sell the home to release one of the parties from the obligation.
Yeah, you mentioned if parties decide to stay on the mortgage together for a while, be sure to make sure your attorney gets language in the settlement agreement that protects you if you're the spouse that may be leaving the home but still on the mortgage. And as you say, I went through that situation myself. We kept the mortgage when I got divorced. We kept the mortgage on the house together for a while before I refinanced, and there were terms that protected my ex-wife who moved out. For instance, if I missed a payment, she would know about it, have the ability to know about it, to make it whole, to seek compensation, whatever the case may be, so that credit wasn't damaged. Um, I think we're probably seeing quite a bit of this stalling or waiting and see, as you mentioned, with issues such as children potentially owning the home until the child leaves the house or graduates from high school is something, um, or perhaps more cases of something I'm hearing quite a bit. People saying, "Well, maybe we'll stall until the market improves and wait for rates to fall." And I think what we're seeing here, and I'd like your opinion on this, is a real recency bias because we've had these extremely low rates, particularly culminating with the pandemic era, um, where people were able to finance 3-4%, refinance 3-4%. The people think that's normal. Well, that's not normal, is it?
It's the furthest thing from normal. And a lot of people don't really understand how mortgage rates work. So there is, I think, a lot of misconception that the Fed has some control over mortgage rates. Well, they have some indirect control, but the mortgage-backed security itself is an investment, right? So we compete against bonds. So a mortgage-backed security is going to be a riskier investment than a bond, right? I mean, you're the financial guy here, so I'm gonna defer to you on that. But typically, we have to pay a higher rate of return than a bond to get someone to buy a mortgage-backed security, right? So when the Fed stopped buying mortgage-backed securities in 2022, that's when you started to see mortgage rates tick up. They were the single largest purchaser of mortgage-backed securities. That's a big number. So now we have to go out and find investors to fill that void, and we've got to pay them more, right? And so that is why rates are part of why rates are where they are today. And frankly, while I do believe that rates are going to come down from where they are right now as we get inflation in check and maybe we get some more accurate jobs numbers, I do think that we're going to start to trend back down, hopefully into the low sixes, maybe the high fives sometime within the next 12 months. But the average 30-year fixed rate from 1971 to 2024 is 7.72%. Right?
Yeah,
That's a
7.72.
high, yeah, a high of 18.63% in 1981, a low of 2.5% in 2021. Right now, we're sitting at about 6.875%. That would be, 80% loan to value, excellent credit, right? No discount, no origination for that. So this idea that I'm going to sit around and wait for 4% to roll back around is not very realistic. I'm not going to tell you that it can't happen, but it probably will not happen without the government getting involved and starting to buy mortgage-backed securities again. And I don't know that will happen.
Yeah, it's a couple of things there. I remember sitting around the living room or the dining room table with my parents when I was still at home. I was probably studying finance at school and talking about sure would be nice if rates got back down to 6%. So,
right.
They used to be quite a bit higher. And of course, back in the early 80s, we had double digit CD rates. Because you're probably too young to remember this, Jennifer. But,
I'm not.
well, inflation was a real problem then. And it seems to have been, it certainly, from the recent numbers, has been trending down. And of course, the Federal Reserve recently lowered its Fed funds rate. But I'm going to throw a monkey wrench into the works here. The prevailing opinion does seem to be that rates are going to go down. But given the results of the last couple of days, what if these tariff that we hear about actually do turn out to be inflationary? and I'm not an economist, and I don't expect you to offer a deep opinion on this too, but be prepared for the unexpected. Current rates may actually look good. There's always that chance if a tariff policy turns out to be very inflationary and puts the brakes on, or causes inflation to reignite.
Well, you bring up an excellent point that rates can always go the other way, right? So the 7% interest rate today might look fantastic 2 years from now if we're sitting at 8.5 or 9%. When I bought my first home in 2000, my rate, I believe, was 8.5%.
Right.
Now things were a lot less expensive in 2000, especially real estate. But I did my own mortgage, right? So if you were paying somebody to do it, it probably was 8.75%, 9%. So yes, be prepared for that. Expect it, and we hear it a lot in the real estate market. Marry the house, date the rate, and that's not good advice, in my opinion, right? Because you're basically getting someone sometimes into a financial obligation that they're not really prepared for. They're doing it. They think it's a stopgap, and okay, well, I can make this payment for 12 months. But what happens after the 12 months? Which, this brings up an excellent point, about refinancing, going ahead and biting the bullet and refinancing when you're divorcing. So here's an interesting figure. The U.S. consumer debt is at a new high of $17.3 trillion. We're also at the highest default rate that we've been at in 12 years. So what happens when people are cash strapped? They've used all their credit, right? Well, homeowners have 32 trillion in home equity. So what we are seeing, and I am seeing it a lot, especially with my divorcing clients, is a cash out refinance.
Right.
So they will use that home equity. Obviously, in most cases, they've got to equalize it, right? Somebody has got to get half if they're leaving. That's typical. And then the homeowner that's staying in the home, the divorcing couple that's staying in the home, they might then tap into more cash to pay off debt that they've accumulated, whether it be credit card debt that they've accumulated during the divorce, or, hey, maybe, and I don't ever recommend this because I don't think it's good to pay off short-term debt with long-term debt, but they may not have a choice. They may need to pay a car off so that they can afford to make the payment on their house.
Well, of course, I would always argue that home debt is a much better type of debt than car debt because you're dealing with what's typically an appreciating asset in the home versus a depreciating asset in a car. I think car debt's one of the worst types of debts to get into. You mentioned with divorcing homeowners and particularly older divorcing homeowners who may have more equity. I think what you're seeing also is some downsizing. So they may be selling a $700,000-800,000 house in New York or California with a ton of equity in it, and then moving to Nevada or South Carolina, and purchasing a place that's quite a bit less expensive, and maybe not even having a loan at all, or maybe just having a small loan, or paying off the loan in the near future. So there's some different ways to approach it, but I think the key thing is that we really don't know where interest rates are going. So ultimately, it's going to be based on your situation and your ability to pay and what your life needs are. I want to get to something you mentioned a moment ago. You mentioned the term assumptions, and this is like the ideal scenario, is it not? For you tell me, but I'm thinking a husband and wife are both on the mortgage, the primary residence. They've got a relatively low interest rate, but they're getting divorced. Can the person staying in the house, if one of the people staying in the house, assume the loan? How does that work?
Well, the answer is maybe. And how that works is you, first of all, you have to have your settlement agreement in hand. right? Recorded, signed by the judge. It has to be a legal document before you can ever even start the process. And it's going to depend on your mortgage servicer. So you call your mortgage servicer, you tell them, I've been awarded the home incident to divorce, and I would like to apply for an assumption. You're basically applying for a new mortgage. It's called a qualifying assumption, right? So they're going to pull your credit, they're going to review your income, they're going to make sure that you meet the guidelines as if you were getting a new mortgage. So it's important to note that in an assumption, there is a release of liability. So one person is being released from a liability. A lot of people will say, well, conventional loans are not assumable. Well, they are at the mortgage servicer's discretion. They do not have to approve the assumption, but they can if they choose to do so. So there is a process, and it is kind of a unicorn because, you may see it more because you work with older couples who may have a higher net worth. They may have some other assets they can trade in order to not have to finance that equity equalization, right? So if you have to finance an equity buyout, meaning you don't have another asset you can trade in exchange for the equity in the home, then an assumption is not an option.
Right.
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 So you've got to have some means to equalize the equity outside of financing it. Right. But if you do, then an assumption is definitely an option that you should 100% explore. You need to be careful. And you mentioned it earlier about making sure your attorney writes the correct language in the agreement. You're going to need some time, and you're going to need a backup plan, because if the assumption is not granted, then you're going to need some additional time to figure out, okay, can I qualify for a refinance? Do I want to refinance? So the language in the agreement is very important.
I want to get to language agreement is always important. I want to get to that a little bit more in a second, but I want to go back to the process, because from a financial planning perspective, was when I'm working with people going through divorce and we're trying to, with the settlement, establish a solid financial foundation for them for the next 20, 30, 40 years. We'd like to know as early in the process as possible whether an assumption is possible. And I've had a client call the mortgage servicer well before the divorce, the ink is dry in the settlement, and they said, yes, this is an assumable loan. So are there variations in, yes, it's assumable, maybe it's assumable, no, not at all, depending on the servicer?
It's not the servicer, it's the type of mortgage. FHA, VA, those are
Right.
assumable. They have an assumable component. Conventional, it says on your closing disclosure that this is not an assumable loan. However, you can apply for an assumption on a conventional loan. We are doing it. We have clients who are having success. There is a process, right? And there are some limitations. So most servicers require that it's your primary residence. You can't have any additional liens on your home typically. So if you have a home equity line of credit, you've got to be able to pay it off outside of this prior to being able to close on the assumption. You've got to have the means to pay for your closing costs out of pocket. That's another thing. On a refinance, we just roll everything in. So, closing costs, prepaid expenses, your new escrow establishment, we just put that all in the new loan amount. But on an assumption, you've got to have the means to bring that money to closing. And the closing costs are just almost mirror what the closing costs would be on a traditional mortgage closing.
Right. So you said FHA, VA, and what other type of loan are typically assumable?
The FHA, VA, I think all government loans, so USDA may be assumable as well.
Mm-hmm. Now,
the majority of mortgages are conventional. I think
right.
It's like 70%.
Right. But it's good to know that you still have a chance.
That's right. You do have a chance. And honestly, if you would have asked me this a year and a half ago, if you would have called and said, I'm going to assume my mortgage, I would say, well, good luck and call me back when it doesn't work out and I'll help you with your refinance. But what I learned is that people are having success. And if you are in a situation where you don't have to finance an equity buyout, then you should definitely pursue that, because that's going to be the best thing for you financially.
Now, when you say pursue that, I've been through this a couple of times where I've advised the client, I said, don't, because this was experience from my own divorce, don't call the toll-free number on your mortgage statement, because that person is not going to help you. Now, is that accurate? I mean, that's what I tell people.
Well, you do have to call the toll-free number to get to the right person.
Yes, but that person who picks up the phone,
that's probably not the right person.
Right.
So you need to know what to say when they answer the phone. And you say, I've been awarded my home incident to divorce. I need to speak with someone about a mortgage assumption. Can you transfer me to that department? So that is the key, is knowing how to get to the person within that mortgage servicer.
Yeah, exactly. So let's say you get to that person and they give you hope. How long does the process typically take?
Well, it's going to depend on the servicer. So Bank of America, they say it can take up to 120 days. PennyMac is 60 days. Flagstar gives you a range of 30 to 40 days. Loan Depot, I worked on a VA assumption, and we submitted the package on May 8th, and you have to mail a package in. It's very, like you got to go and, to the Postal Service or UPS. They want a physical package in hand. We had a conditional approval on the 17th. So less than 10 days later, we have a conditional approval, and that client closed on June 14th. So less than 45 days, right? From start to finish. Now, it took us some time to get the documentation together, because you literally are submitting for a new mortgage. You're going through an underwriting process, and when the consumer is doing that, you're missing a key member, which is a loan officer. As a loan originator, that's what I do, right? I talk to you. I say, hey, Andrew, here's all the things that I'm going to need from you. These are the things the underwriter is going to ask for. I'm going to review all those things before it goes to the underwriter. I'm going to say, the underwriter's going to have a question about this, this, and this. We need to address these things. We need to make sure your application is complete and thorough. And that's the missing piece. So it can be a challenge to the layman to get through that process without a loan officer.
Yeah, no, for sure. You definitely want to do that. We've talked, this is being the Gray Divorce podcast, where we're talking quite often about situation of people getting divorced later in life. And with age comes the ability to qualify for a home equity conversion mortgage, commonly known as reverse mortgage. Now, I've typically, as a financial advisor, been very leery of these, because there are products in the world that tend to be sold by salespeople, and which doesn't necessarily mean that it's not a good product, but it's a good product for people in the right situation. And with some of the reforms made to the reverse mortgage world, and my exposure to how this can be a creative instrument for an older couple selling a home to dispense with a mortgage going forward through the home equity conversion for purchase process. I wonder how the current interest rate environment is affecting this market.
Well, I agree with you that product is not for everyone. It's probably sold to people that it should not be sold to. In my opinion, it would be just a last case scenario, because there are other less expensive ways to accomplish the same thing. It really, in my opinion, is for people that don't have any other options, because they're high cost. The upfront fees on a HECM are pretty substantial. You know, over $10,000 in most cases. You have to pay a funding fee to FHA. That's 1.75% of the loan amount. You have to pay monthly mortgage insurance. And even though you're not paying these things, they're getting tacked on. So,
Right. But let me play devil's advocate for a second. What if we're talking about a 70-year-old couple that's divorcing and one of them semi-retired and the other is not working at all? How are they going to get conventional financing after divorce? They're not, because lenders want to see income.
well, we can use assets as a basis of repayment. So oftentimes we do see someone who maybe has a small pension and Social Security, or they just have Social Security, but they may have, $500,000 in investments. We can use that as qualifying income. So we take it and divide it by 240. So there are other ways, right? Home equity lines of credit are great, and they're easier to qualify for. They're based on prime, so right now they're not quite as attractive as they would have been, when the prime rate was, 2, right?
Right.
But that's also, the closing costs on a home equity line of credit are going to be minimal compared to a reverse mortgage. You can make an interest only payment for 10 years, right? So you can draw out enough to make your payments. You can invest that, right? Right now you can get 4.5% on an Amex high yield savings account, right? So you can offset some of your interest expense by your interest earning.
I think the bottom line is that everybody's situation is unique, and that we have a toolbox full of methods for financing, and ultimately it's between the financial advisor and the mortgage professional to determine what would work with the individual in question.
That's right, and that's why it's very important to have a team, right? You don't just need a family law attorney. You need a financial planner. You need a mortgage professional, and they need to be working in lockstep. Hey, we're going to put our heads together and figure out what's the best way to move forward long term.
Exactly. Neither of us have passed the bar, but I'm sure both of us have had experience with attorneys who have some issues with simple math, and I would not claim to know the ins and outs of mortgage financing, which is why I defer to experts like you. So this is a message that's consistently put across on the Great Divorce Podcast: the necessity of having the appropriate financial professionals or divorce professionals for finance, mortgage lending, and of course the legal professionals for your situation. Don't have a lot of time left. This conversation is really zooming by here. Excuse the pun. But I wanted to ask you quickly, because we talked about, I want to talk about some general issues that where you, as a certified divorce lending professional, can add value to somebody going through the divorce process. And I guess one thing is, we're talking about qualifying for a mortgage. Can support income from alimony be used to qualify for a mortgage? Thoughts?
Yes, it can. And there are time constraints. You have to have received it for 6 months. So this would be important for an assumption or qualifying for a new mortgage, because remember, the guidelines are going to mirror each other. So if you know I need alimony to qualify, then you need to have a timeline that allows for that. So you have to receive it for 6 months, and it has to continue for an additional 36 months. So you need 42 months, and you really need a cushion, because all the stars have to align perfectly, right, for you to hit the 6 month mark, and then boom, I close and I got my 36 months continuance. So really you need a couple of months cushion.
I always, when somebody comes to me for a consultation in divorce before they've hired an attorney, and if I see that mortgage refinancing, financing for a new home is going to be an issue post-divorce, I always ask them, ask your attorney if they're familiar with the 636 rule on spousal support and mortgage refinancing. And if they have no idea what you're talking about, you should bring a divorce lending professional into the conversation.
Well, that's yes. Are you aware of the 636 rule? Most attorneys would say, "What are you talking about? I have no idea what you're talking about." But, that's where we bring value to the attorney. We can say, "Hey, listen, we've got X amount of dollars to work with here. So how about let's take less every month, but we're going to run it out over a longer period of time." Right? Because that's going to accomplish what we need to
Exactly.
accomplish.
Exactly.
Right?
Because the person lending the money is going to read a divorce settlement different than an attorney, and they're going to look for things like 636, and it's just a simple rephrasing of the terms of the settlement. It doesn't need to mean a difference in money, but just stretch it out a little long, stretch those payments out a little longer.
That's
And
right.
all of a sudden, the mortgage lender, oh, I can work with that. I can't
Right.
work with 12 months of support, but you reduce the amount and stretch it over 36 months, we can do something with that.
Right. And you may not run into this as much with your listeners or clients, but if you're relying on child support the rules are the same. It's got to continue for 36 months. So if you've got a high schooler that's about to age out, right? They're 16 right now. Well, that doesn't continue for 36 months unless it specifically is written in the settlement agreement that it's going to continue. So you might reallocate some child support to alimony in order to use it as qualifying income.
Great point, Jennifer. Great point. One final question, because I deal with a lot of cases where usually the wife has given up a career for a while to raise the kids, and then divorce happens and they plan to go back into the workforce. How does that work in terms of qualifying for a mortgage? How long does someone, let's say if they've got a degree in engineering, but they haven't been an engineer for 10 years, um, how long do they need to be back in the workforce before they can qualify for a mortgage?
Great question. We do get that often. In that particular situation you just mentioned, you may have someone who decided, whether it be the husband or the wife, decides to stay home, take care of the children. And interestingly enough, Fannie and Freddie are silent on return to work, which means they don't have an actual guideline. It's really more at the underwriter's discretion and how you're compensated. So if you're an hourly employee, they're probably going to want you to be back at work for about a year to make sure that your income is consistent and stable. Those are the two words of the day with income, qualifying income. It's got to be consistent and stable. Well, how do we define that? If you are working variable hours, it's going to take some time to define what's consistent and stable. If you were an engineer and you go back to work working for an engineering firm and they pay you a base salary, 99.9%, we're going to let you close immediately. We probably won't even ask for a pay stub, just an offer letter. That's non-contingent, right? So it depends on the situation, and it is a great question, because when I get involved early enough, I can coach them and say, don't take a commission job, because you're going to need at least a year of on the job. We got to have a year history of commission to use it to qualify. Don't take an hourly job. I mean, take a salary job, even though it may be less money, we can use it to qualify, right?
Increasingly in these days, you're seeing people who've got their own businesses, and I see this with a number of women who start to ramp up the business, in the later stages of divorce or the years following, and they may not even pay themselves a salary, but the business is profitable. When will a mortgage lender, look at that income and say, okay, that works for us. We can use that.
Typically, it's going to be 2 years of tax returns. There's a new guideline that if you were in the same line of work previously, they'll take a year of tax returns, but they're going to use whichever income was less. So if you made less money working for someone as a W-2 wage earner, they're going to use that income to qualify. So, typical rule of thumb is 2 years, but there are exceptions to that.
Cool. That's good to know. Look, Jennifer, a lot of valuable information here. Really appreciate your coming on and educating our listeners and myself on some of the options out there, particularly the stuff on assumptions. I wasn't aware that it could be done with conventional loans, so that's gives many of our listeners hope that may be done. Speaking of our listeners, how can they find you, Jennifer? Is it restricted? Are you restricted to those states I mentioned earlier?
Well, I do have a consulting service for assumption submissions, and I am not restricted. I can assist with an assumption submission anywhere. And that you can find me at divorcemortgagehelp.com. I originate mortgages in Alabama, Georgia, Florida, South Carolina, and Tennessee. And you can find me at jenniferbbrown.com for loan origination services. So I can't help with an equity buyout, refinance, or a purchase unless I'm licensed in the state. But the consulting arm that works with clients who are interested in pursuing an assumption, I can work with anyone.
Okay, so the assumption consulting service is divorcemortgagehelp.com, and your traditional refinancing, financing service licensed in Alabama, Florida, Georgia, South Carolina, and Tennessee is Jennifer B. Brown. That's 2 N's in the Jennifer, right?
That's right.
So you got 2 N's and 2 B's in there.
That's right.
Well, 3 N's if you include Brown. JenniferBBrown.com. Great.
Yes,
Awesome. Awesome, Jennifer.
Thanks for having me, Andrew. It's always a pleasure.
Thank you very much. It was great.
Thanks so much for tuning in to this episode of the Great Divorce Podcast. To learn more or get in contact with your host, you can visit Andrew's website at transcendretirement.net. Also, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. That helps others find the show, and we'd greatly appreciate it. Thanks again for listening, and we'll catch you in the next episode.
Information provided is educational only and should not be construed as legal or tax advice. Each situation is unique and should be discussed with your tax or legal advisor prior to implementation. Andrew Hatherley is not an attorney and does not provide legal advice. Information provided is financial in nature. Advisory services offered through Hatherley Capital Management, LLC. Divorce financial analysis services offered through Wiser Divorce Solutions, an affiliated company.